Welcome everybody, and welcome back to another video on financial analysis. My name is Ted Wainman, and today we are going to be taking a look at ASOS, as seen on screen, an online fashion retailer. Hopefully some of you will have heard of them. So let's just see what they do. ASOS, a British online fashion and cosmetic retailer founded in 2000, primarily aimed at young adults, the kind of people who watch Love Island. Not that I watch Love Island. Well, okay, maybe occasionally with my daughters. The website sells over 850 brands, as well as its own range of clothing and accessories, shipped to 196 countries from fulfillment, basically every country in the world pretty much, from fulfillment centers in UK, USA, and Europe. So that is what they do. Now, the aim of this session is to help you read and interpret financial information, to become increasingly fluent in your ability to talk about finance and to read the story behind the numbers of a company. You may also want to be using this as part of your investment thesis, but this is not an investment channel. So hopefully we can provide some insight. Maybe you are selling to them, maybe you're buying from them, maybe you are interested in working for them, maybe you already work for them, maybe you're just interested in the performance of the company, maybe you are an investor, maybe you are someone who wants to short the company, for example. So lots and lots of people who might find this of interest. This is in fact a request from a couple of our subscribers. We actually did ASOS back in October 2021, so exactly a year ago. That was a request by John, and then since then, just recently, we've had Zivko, hopefully I've pronounced that right, Zivko and Alex have both requested that I have another look at ASOS, and so this video is for you. If you like what you see, please do like and share and subscribe to the channel. So if you're not already a subscriber, please do subscribe to the channel. And if you have any feedback, any comments, you like what you see, if you don't like what you see, then please do use the comments, but remember to always be polite. And on that basis, we do most of the videos that we do on this channel are requests by our subscribers. So if you are interested in a particular company, you want me to have a look at them, then please do just send me your request, put the request in the chat. The more information, the more kind of the background you can give me as to the reason for your request, the more likely I am to have a look at it. We do get a lot of requests, so I can't promise we will get through every single one. Okay, so without further ado, let's jump on in and have a look at the accounts and see what is going on. So these numbers, they're available on the website of ASOS. So very easy to find. Just type in annual report and accounts, and you will find this document here, published on the 19th of October. This is being recorded on the 25th of October. So these are reasonably up to date. This is a reasonably up-to-date set of accounts, reasonably up-to-date information. Lots of information about the company and what they do. We're just going to gloss over that. I'm really interested in getting stuck into the actual detail of the numbers themselves, and so we've got to sort of scroll down until we get to page 19. Not a lot of, not a big glossy brochure, you'll notice. So revenue, the revenue for this business has increased. They are up at nearly 3.9, nearly 4 billion pounds. Okay, so we're in millions. You'll notice we're in millions up here. Just a quick note to say that they are unaudited at this stage. So, the auditors haven't been in and checked the numbers, but I think we can be reasonably confident there's probably not going to be any kind of major gremlins that we would expect the auditors to find. Revenue, so there's our revenue, 4 billion, 3.9 billion. Cost of sales, the cost of the thing that they're selling, so all that kind of clothing, 2.2 billion. Which gives them a profit, a gross profit, trading profit of 1.7 billion, which is about 44%. So if you pay, for example, £10 for a dress on ASOS, or a pair of trousers, for example, you pay £10, it's going to cost them about £5.60 to buy or make that product, and they get to keep the other £4.40. The problem is they've got to run the business, and they've got their distribution expenses. So this is all the cost of actually shipping it to the customers, because of course it's online. So what they save in rent, they're having to pay in shipping, and then they've got all the admin expenses sitting as well. And this will be sales, marketing, finance team, HR team, IT, facilities, and board of directors, and all the other kind of costs you'd expect in terms of running a business. And those have increased. And as a result of that increase, because they've been operating at such a low margin, their operating margin last year was only 5%, and the year before, and now they've actually tipped into a loss, £10 million loss. So it's not a massive loss on a 4 billion turnover, but it is a loss. And this is a low margin, a very, very tight business. And this is a bit of an issue for them, because you'll notice the next line down, they've got this finance expense. That's the interest they're paying on their debt. So when we look at the balance sheet, we will see their debt. We expect their debt has gone up because their interest has gone up. And this is the problem, because they are making a loss and they're paying interest. So this is a very important ratio known as the interest cover. And it says, can you afford your debt? And the fact that they are operating at a loss is a cause for concern. Let's put it like that. So loss before tax, 31.9 million. They get a little tax refund, and the loss for the year is basically 31 million pounds. So the previous year, they're actually turning a profit, a pretty small profit. It's only a 3% margin. So these guys are operating, wafer thin margins, really, really tight. And you can start to see that, they need to make this margin here in order to be able to pay for these overheads, these costs at the back end here. So there's our income statement. I don't think, there's a few issues in there, but relatively straightforward. I hope you'll agree. We scroll on down to the balance sheet. Here is the balance sheet. Nothing really jumping out at us. There are a couple of issues in here, but they've got, the intangible assets. So we kind of think, well, what are those intangible assets? Goodwill that, they've grown by buying. They bought other brands, so there's some goodwill sitting on there. Other intangible assets will be things like their software and their website, etc., and that's a reasonable amount, and that's pretty specific to the company. So if you close the business down, don't expect you to put that on eBay and get 648 million pounds for it, for example. Property, plant and equipment, these will be the tangible assets, tables, chairs, computers, etc., so about 1.4 billion of non-current assets. Just scroll down a little bit and we'll see, bring the current assets and the current liability. So the current assets, these are things which are either cash or going to become cash soon. So typically for a company like this, inventory that they're trying to sell, trade and other receivables that they are due, and then cash in the bank. And they've got a couple of other bits and pieces too. This derivative asset here, this will just be them using derivatives in order to manage their exposure to exchange rate differences, for example. And you'll notice that there's a derivative liability that kind of offsets it. So don't worry too much about that, relatively small numbers. 1.5 billion, nearly 1.6 billion. The big issue here is this number here. That's a lot of inventory to be carried. So they've got a lot of inventory. In fact, most of their current asset is sitting in inventory. Really, they've got 323 million of cash, which is reasonable, a bit down from last year, but it's reasonable. Most of their current assets is inventory. They've got to be able to shift that inventory. If they can't, they have a problem. Trade and other payables in the current liabilities is the biggest number. We'd expect that, and there's really nothing else there to write home about. And so the total current liabilities about 1 billion. So in our kind of traditional liquidity ratio, those of you who have been watching for regular viewers, you'll know that we like to compare the current assets to the current liabilities and just see what this ratio is. And I can tell you, because I've worked it out, let me just check my notes. I can tell you that the ratio is about 1.49. So that looks pretty good to me. 1.49, pretty comfortable. It basically says for every £1 these guys owe and have to pay soon, they've got £1.49 either as cash or coming in as cash soon. Okay, that's looking good. The problem comes when we look at what we call the acid test or the quick ratio. And the acid test is effectively exactly the same, only you just remove this inventory. And therefore, what you're doing is you're comparing the rest of the current assets. And really, we're kind of, these guys, they have no trade receivables because, effectively, if you buy a pair of trousers from them, you stick your credit card, your debit card in, and it automatically goes. So there's no credit. So it's really about cash. And if we kind of, just look at, comparing it, if you've got 323 million cash and you owe your suppliers nearly $1 billion, then you are very dependent on your ability to sell your stock, your inventory, and the acid test, the quick ratio is 0.46, which says for every £1 they owe and have to pay soon, they've only got 46p if you ignore stock. Okay, so these guys are very dependent on their ability to sell that inventory. Now, again, this is quite important. So let's have a look at the working capital requirement so we can work out the working capital. Now, this is very back of an envelope, but if you take the average inventory, and that's just really adding these two numbers together, and you divide it by the cost of sales and multiply it by 365, you get an estimate that it takes them 155 days to sell their inventory. Now, that's a long time, 155 days. So they've got stuff sitting there for 155 days before they actually sell it. Now, fashions change, and fashions change pretty quickly. So again, that's a little bit, makes me a little bit nervous. Their accounts receivable days is only about 7 days. It's very, very small. And we'd expect that because, everyone's paying on debit or credit cards, and you pay before it gets shipped to you. And then their accounts payable days is 143. Okay, so now if you're a supplier to these guys are going to really push back on you. They're going to really negotiate hard payment terms, mainly because they just haven't got the cash to be able to pay you any earlier. So caveat supplier, or in this case, if you are a supplier, you are going to be, you're going to be squeezed on those payment terms. 143 days. I have to admit, none of my clients pay on 143 days. Luckily, I'm very lucky with that. And you know what? And if they did want to pay on 143 days, I'm not sure I would be supplying them. So again, this is useful if you're supplying to an organization like this. The ability to kind of to understand and read these numbers is absolutely vital to you. Otherwise, you might not get your invoices paid on time. So anyway, so this working out, I mean, basically it takes them 155 days to sell the inventory. It takes them 143 days to pay their suppliers. So those two are sort of pretty much matched. But there's liquidity concerns around this organization. The only other item to notice is the borrowings. Down here we've got the kind of the long-term debt. So we noticed that they do have, they do have debt. You remember we looked at their interest, and my understanding, reading the press recently, is that they are in negotiations. They got a £350 million revolving credit, and they're in negotiations with the banks. Now, again, if the banks don't agree to extend that, or they won't give them favorable terms, and don't forget, we're living in a world where inflation is going up and interest rates are going up, so the cost of that debt is going to go up. Then these guys, they're facing quite a lot of headwinds. Okay, so those are some issues I think that these guys are actually facing. The last thing to look at is the well, we can look at the movement in equity. I don't think there'll be anything exciting going on there. They're not making a lot of profit, so there's no dividends being paid out. So here's our movement in equity. We'll just highlight it. So here we're looking at this column here on the right hand side. There's the loss coming through. There's no payments of dividends. There's no share buybacks going on. We wouldn't expect that. They haven't really got the cash to be starting to dish out money to shareholders. So they're trying to keep everything in the organization. And so let's go and have a look at the cash flow. So here is our cash flow. And again, we now have our second, or our sort of third big warning flag, which is this number here, negative cash flow. So you'll remember from the balance sheet that they had about 323 million in the bank. And so if you've got 323 million in the bank and you are burning 120 million from your trading activities, your core trading activities, then you're going to run out of cash in 2 or 3 years, for example. Now, why are they burning cash? Well, look at the big number. Here it is. It's increase in inventory. These guys, there's a huge amount of inventory going on here. And why? You know, in 2 years, they've managed to tie up an extra £500 million in inventory. And I don't know why. Are they buying stuff that they can't sell? Now, when you hold inventory, you have to hold it at the lower of cost and net realizable value. So, you know, again, fashions are changing. And if it costs them £10 for a pair of trousers and they can only sell it at £4, and they need to actually write it down to that £4. I don't know if they are convincing the auditors that they can actually sell this stuff, or whether the auditors are actually saying, you know, you need to be writing this stuff down. But it looks crazy, you know, without that 258, they got positive cash flow. So, you know, maybe they need to kind of rethink their inventory holding strategy, for example, because I think this is causing them quite a few problems. Investing activities. So this is the payments to acquire intangible assets. Quite interesting. There's a lot of money being spent on these intangible assets, and I think it's probably worth just having a look at that. So just remind ourselves, when we're in the balance sheet, we were looking at, you know, there are these other intangible assets, and we are expecting that to be mainly software. We'd expect there's a note in the accounts that might provide us with a bit more information on that. Unfortunately, these guys don't give us any further detail on what those intangible assets relate to, but it looks to me like it's probably some form of software. So it's not the goodwill, it'll be some kind of software, for example. So again, there's our so that looks to me like what these guys are doing, and payments to acquire intangible assets. You know, I'm guessing here, this is pure guesswork here because I've got nothing else to go on, but it's looking to me like these guys are, you know, they are effectively capitalizing, you know, the costs of developing. You know, if it is software, then they're spending 100 million a year developing that software, and they are capitalizing those costs. Now, let's hope that software is actually delivering, you know, and that it actually works, and that it's not on a project which is being built on the nether, for example. Last section is the financing activities. So we've got the there's not a huge amount going on in the you know, so the loan is still sitting there. They haven't sort of, you know, they're not raising any more debt. They're not that's these two numbers here. Little bit of a repayment going on, and there's the actual physical interest which is being paid, which is quite interesting. So a lot of the interest that we see, you remember, it's about 23 million. Some of that interest is not actually physically being paid back. It'll be kind of rolled over into the loan. So there is our kind of our view of the company. There we go. There's the cash at the end of the year, 323 million, which for this company, it's on the light side. Let's put it like that. It kind of just looks a little bit light, and you know, that liquidity ratio makes me a little bit nervous. Now, what's quite interesting about this, so just a couple of things we'll just whiz through and just highlight sitting in the notes. So if we do actually go down and look at the notes, a couple of things we might want to just be aware of. So business combination, 4th of February 2021, they acquired Arcadia Group, which I thought was quite interesting. So obviously that's not in these accounts, that's in the previous set of accounts, and they've kind of recognized, and that's where the goodwill effectively arises from. And the reason I mentioned that because Mike Ashley, through House of Fraser, that he is a major shareholder of, has just acquired 5% of these guys. Now, I think that's quite interesting. Mike Ashley, obviously House of Fraser, owning the House of Fraser and the Sports Direct brands. Mike Ashley coming out through the Sports Direct kind of brand, you know, suggests that you know, maybe he sees an opportunity here. So, you know, if we think about what the share price has been doing, here's the share price over the last, well, you know, many years. In fact, this was the last time we looked at it. So this was October 2021, and you can notice that the market cap was 2.3 billion. I can't remember what my recommendation was at the time. Somebody will probably dig out a video and say, "Oh, Ted, you said it was a very, very cheap buy and it was just going to go up." And look at the chart, and we were all going to be millionaires, and I've lost a fortune on it. I'm not sure I would have made quite that sort of punchy comment, but anyway, where's it got to today? So we can see actually it's fallen even further, and it's now at about 600 million. So just to remind ourselves, we're talking about 600 million. If we look at the balance sheet, if you were to buy this company for the 600 million, you're getting a company with a balance sheet. The net assets of this company is a billion, that 1015. So there's the billion of net assets you're getting, and you're only going to pay 600 million to get it. Okay, so in theory, you should just be able to buy ASOS, close it down, sell off all the assets, pay off the liabilities, and you're going to bank about 400 million. Now, it doesn't actually work out like that quite in practice, because you've got leases to pay, and you'd have to pay redundancy costs, and so there's a lot of hidden costs that we're not aware of. But it does suggest that these guys, they're trading, they're very, very cheap. They're trading on a below book value. They're trading on a discount to their book value. And that often provides us with a potential buying opportunity. So basically, it's telling us, these guys are cheap, and we can see what's been happening since we did the last video. They've been going downhill basically. So last time we did our analysis, they were trading on a P ratio of let me just check my notes. It was about 17 times earnings, and now obviously they've booked a loss. However, quite interesting that Mike Ashley is now is a significant shareholder. Now, it doesn't mean he runs the business, but he can kind of make 5%. He can certainly make his presence felt, and he, or under the umbrella of House of Fraser, are used to running low margin kind of at the let's say the more bargain end of the kind of the retail spectrum. They're not up at the kind of the Gucci and Primani area, so they're much more the kind of the cheaper end, and he knows how to extract value. So be interesting to see whether this is a is this a buying opportunity? Is this cheap, and actually there's going to be a turnaround, and it's going to start to kind of thrive and sort out some of its issues around the debt, sort out some of the issues around its liquidity, or actually is this a company which is continuing to go down? Certainly Mike Ashley thinks he's managed to pick up a bargain by extending his ownership of ASOS. So if you're thinking if you're thinking Ted, this is the nadir, it's only going to be upwards from here, then fantastic, fill your boots. But I wouldn't suggest that you you don't put your whole house on the line. I'd only sort of make a sort of reasonable bet, anything you can afford. And if you're thinking it's actually going to carry on down to zero, and you're sitting in the shorts, then make sure that you have your stop losses in place, and that your first loss is usually your best loss, and then you get out early if it does start to take off. So there you go. That is my analysis of ASOS. I'm not sure I've managed to kind of provide well, hopefully I provided some additional insight, and giving you some food for thought in terms of how the company is performing. Okay, we look at the financial, we look at the finances. The finances are for the previous financial year. Don't forget the share price is always looking to the future, so it's pricing in the expectation of what's going to happen in the future, not what has happened in the past. But often history has a tendency to repeat itself, and the past is often a good indication of what might happen in the future. So thank you very much for listening to the video. I hope you like what you've heard. If you have, then please do remember to like, share, and subscribe, and I will see you on the next video. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.